Hey, Chip Nellinger here with Blue Reef. Wanted to give you installment number 2 here of the biggest lessons the market has ever taught me. Again, this is number 4 on the list, but not of importance. All 5 of these are going to work hand in hand together. There's not one that's more important than the other. This one's an old trading adage that to me has some very recent real term use, and that trade what is in the market, not what you expect the market to do. A lot of wisdom in that. I'll tell you something here. I trade a lot of other markets other than the grains and the livestock speculatively. This is a story that has direct implications from a hedging standpoint, but came from my speculative trading here recently. Early in the month of January, commodity index funds have what's called a rebalancing. I was doing a little research into that. I learned that in the cocoa market, the commodity index funds had a massive amount of contracts to buy on the long side to rebalance their positions for the new year for the investors in their funds. I looked at the chart. I saw what was starting to be a nice pattern of higher highs and a pattern that is one of my go-to patterns to get long. And I thought to myself, boy, these funds are going to buy a tremendous amount, 40, 50,000 contracts of cocoa in the next 5 days to rebalance it. That's surely going to push this into the trigger for this long position. So I got long in anticipation of the index funds pushing the cocoa market higher. I traded what I thought the market was going to do instead of what was in the market. Now, what happened was, after the first day of the index fund rebalance was a little bit higher. I thought I might be onto something. Second day of the 5-day index fund rebalance, market closed significantly lower. I thought something's not right. And I immediately got out of that trade on the long side. Luckily, because over the next 3 days and since then, the cocoa market's imploded. Point being here, I was projecting my own expectations onto the market of what I thought was going to happen in cocoa instead of trading what was happening in the cocoa market. You can very simply put a couple overlays. Number one would be a moving average, right? There's an old adage in the markets here from the trading floors. The trend is your friend, right? It doesn't matter if the corn market's chopping around in a 10-cent range or the cattle market's chopping around in a $4 range. No one's making much money there. And it doesn't really matter to you at that point from a hedging standpoint. What you want to be part of is a 30, 40, 60-cent rally in corn and a $10, $12 rally or sell-off in the cattle market. How do you do that? Watch some moving averages. Overlay a moving average, whether that be a 20-day, a 50-day, even watch a 200-day moving average. How is the market? Is the market above that? The moving average? Is it below the moving average? Also watch some swing highs, some pivot highs. If you don't know what those are, Google those. A very simple concept. If we're seeing swing highs, higher highs and higher lows, that's a definition of an uptrend. When we fail to make a higher high and make a new lower high, that's a tip off that the trend might be changing. So those are just 2 examples. Overlay a moving average, look at previous swing highs, swing lows. Where are we at in relation to the 2 or 3 previous swing highs or swing lows? And that will help keep us out of trouble and saying, what is the market doing? Is the market making higher highs and in an uptrend, or have we stopped making higher highs and now we're making new lower highs and lower lows and have changed the trend? Don't expect your projections onto the market thinking, I think we can go higher. I hope we go higher. Trade what is. So again, that was again over 35 years, something that continues to pop up. It's still a daily struggle to fight some of these battles in this market, but trade what is, not what you expect in these markets. That'll do it for this installment. If there's any questions, reach out.